Good morning, everyone here at CamEd Business School, and a very good morning to you, Professor Charles Whitehead. Today we have a great honor because we have a visiting professor from Cornell Law School. So welcome on our interview series, and I hope that today we will have a lot of fun talking to you about what securities law is all about from the US perspective, and then I'll try to pin you down on what you see as likely going to happen in our infant capital market.
Sure.
Without a further ado, why don't you introduce yourself in a nutshell?
Yeah, sure. So I'm a law professor at Cornell in New York. My areas are financial regulation, capital markets, complex deals, corporate governance, things like that. It partly reflects the fact that before I became an academic, I was a banker and a practicing lawyer. And I worked in New York and London and Tokyo, both as a lawyer as well as a banker, and that partly informs what I do as a professor as well. And I will say it's great to be here. I'm thrilled to be hosted by CamEd, and I'm having a lot of fun getting to meet the faculty and the students and folks here in Phnom Penh.
The pleasure is from us, in fact. Okay, so I know that the U.S. is big on stocks and all that, right? So, like every single one, the U.S. would own 1, 2, 3 stocks from elsewhere. So it's like it's part of life. It would be unusual to find Americans who don't own stocks. But okay, be it as it may, we also know that there's a lot of things going on. Some public companies have become private. That is interesting to note. So what's going on in the U.S. securities market?
So the image of Americans individually owning stock is becoming less and less common. It's not to say that Americans aren't exposed to the stock market, but not directly. Perhaps they have an interest in a pension fund. It's a government pension fund. Or maybe it's a company pension fund. And they might invest in securities. And so indirectly, I'm the beneficiary, but I don't own them directly.
Right, okay.
Or maybe I have an insurance policy and the insurance company has taken the money, and one of the things they've done is invested in securities. And so again, indirectly, I get the benefit of the securities, but I don't own them myself.
Right.
But what this means is that over time, increasingly, you're seeing a more institutional market. About 80% of the market right now in the United States is institutional.
Right.
And so it's become much less common over time for individuals to own a lot of stock directly. And part of the reason is because one of the ways in which you manage risk is by diversifying your investments. So instead of putting all my money into one stock, I invest over 30 or 40 or 50 stocks. Well, it's much easier for an institution collecting money from lots of different sources to invest in 1,000 stocks or 100 stocks than for me to do it. And so it actually makes sense from a risk management perspective, from the perspective of trying to avoid taking significant losses, hopefully relying upon professionals, not always, who hopefully can do better than I could in investing in these securities. But anyway, so as a result, you see this increasing institutional focus. And at the same time, you're also seeing companies choose to not go into the public markets. And so it's a kind of convergence.
Right.
You see greater institutional investment on the one hand. You see companies that might otherwise access the public markets choose to stay private, or as you mentioned, potentially go private.
Right.
And so the question is, what's driving this? And there are a number of things that are driving this. So we've talked about how individuals are relying more on institutions, and that's driving this market towards an institutional market. What it means is, you have these very large, sophisticated institutions that are managing money. In the United States, there are all sorts of special exemptions from the full course of securities regulation if you're dealing with these large institutions. And so it means that I can access now as a company the exact same capital that 50 years ago I would have to go into the public markets. Now I can do it through this much more concentrated, sophisticated institutional market. So I don't need to be public in order to get access to the same capital.
Okay.
So that's part of it. Part of it is the market has become more liquid. So it used to be 50 years ago that if the stocks, if the securities were not public, it meant that investors would buy and they'd have to hold for an extended period. There's a lot of risk with this. The markets, the private markets, have become more liquid. Part of it is because of technology. Part of it is because of these institutions that I mentioned. Part of it is because the law has become more flexible.
Right. Okay.
So now the risk of buying in the private market is less. So again, if I'm looking to raise money, I don't have to go to the public market. I can access the same sort of money in the private markets, and the private markets are now more liquid.
Okay.
So that's one more thing. Just being public is really expensive. There's a real risk to being public.
So it seems.
I have to, particularly after a series of regulations that really began in 2000, something called the Sarbanes-Oxley Act.
Okay.
After Sarbanes-Oxley and other laws, it just became more difficult and expensive for me to be public. So on the one hand, the benefits of being public have gone down. On the other hand, the cost of going public have gone up.
The compliance costs.
Compliance costs. And so not surprisingly, you've seen in the last sort of 10 years a slowdown in companies that are going public, so IPOs are less. And as you mentioned, you also see public companies that have decided to delist and to move back into the private sector, the private company sector.
Okay, now just on that particular note, when you mentioned the new law that now requires more compliant checklists, right, because of the financial crisis back in the 2008, 2009, take us through in a very nutshell, right, to non-specialists, what drove that crisis? What caused the crisis back in 2007, 8, 9? So
really we're talking about two crises, right? The Sarbanes-Oxley was passed in 2000, 2002. Dodd-Frank was a response to the financial crisis in 2008.
Right.
So the Sarbanes-Oxley was actually a response to a whole series of scandals.
The lobbyists.
Well, lobbyists, but also what happened was you had companies, there was a company called Enron, for example, and WorldCom. These were huge companies that turned out to be, in many respects, frauds. And so Sarbanes-Oxley was a reflection of poor corporate governance, poor oversight, and so as a result, a greater need for regulation.
Sure.
In 2000, I guess. Dodd-Frank was a response to the financial crisis. And there again, the view was that there had not been sufficient oversight over the securities markets, that the people that you would normally expect to protect the industry weren't doing it.
Right.
And so as a result, there was a need for greater independence, there was a need for greater oversight, there was a need for tougher tools of enforcement. And so the one theme from both Sarbanes-Oxley and Dodd-Frank, they are always regulating against the last crisis, right? They are responsive to the last crisis rather than looking ahead to the next crisis. And that was a large part of what you saw both in Sarbanes-Oxley and in Dodd-Frank.
Looking ahead to the next crisis, the ability to do that would be great, but I think in real life, perhaps we just don't know how to look ahead 10 years from now, right? But be it as may, maybe let's go back to the stock market. Cambodia, as you know, right? You have been noticing, we have had conversations. Our market, capital market, is at the beginning, right? We are still in the infant industry setting. So from your perspective, what is it that our regulator need to be looking for?
So in fact, I think, as I understand it, the regulator is focusing on what I would focus on, which is education, really with a view towards creating trust in the market. The problem with having a new market is It's not very liquid. There are potential for real risks. There are always concerns about fraud. I know that there were problems with the collective investment trust, collective investment management vehicles here in Cambodia. And so what you want to do is inform the consumer. The more they understand the risks, the more they can manage against the risks, and hopefully as a result they will trust the market more because they'll understand more what's going on in the market. And so an informed consumer is a good thing.
Right.
You know, there's a view sometimes that, well, you know, Wall Street banks don't want informed consumers. In fact, that's not true, because if you have an uninformed consumer, they will not understand what's happening and they'll think there's something wrong.
Sure.
So education and information are key, because ultimately you need to create a trust in the system, that the regulatory oversight is sufficient to protect investors from you know, abuses, fraud in the market. And another aspect of this, and again, I think Cambodia, as I understand it, is moving in the right direction, is to have tough regulation. Now, it's interesting. People sometimes think, well, you know, banks and broker-dealers and investment managers, they don't want tough regulation. But in fact, they benefit from tough regulation. If the regulation is reflective of market reality, but at the same time is tough, it means, again, as a customer, I can be more comfortable that, you know, if I put my money in the market, I'll invest. And so as a result, more people will invest, more capital will be available, the market becomes more liquid, and hopefully everyone ends up benefiting.
Right. Now, let's maybe now go outside Cambodia for a moment, right? In history, of course, we have had developing countries elsewhere in the world, South America, everywhere. They try, right? Some mechanism whenever they want more money. For example, if the local savings aren't enough for a particular investment, they will have to think outside the box. Well, we will have to create a company offshore, and that company could go ahead and collect investment, and then that company will come back and invest with us, right? So could you explain that structure,
Sure.
Your structure, in a very non-specialized way so that everyone can easily understand?
Yeah, so what you're referring to is something called either asset-backed financing or sometimes receivable-backed financing.
Okay.
And here's the basic problem. Rating agencies, we're talking Standard & Poor's, Moody's, Fitch, these are all international rating agencies. They don't simply rate individual companies,
Right.
they rate countries.
Okay.
And what they say is, well, we think this country has a certain credit quality because of economic stability or instability, because of currency, because of the government, and so forth. And so they provide these ratings. Companies within those countries can never go above the country rating.
Right.
So if the country is rated, let's say, a B rating, an individual company may in fact have a AA rating, except it's located in the country, it will never go above a B.
Right.
Now, why is that relevant? It's because investors are very sensitive to the credit rating of the companies they invest in. In fact, in the United States, there are many large institutions that cannot invest in companies that are below investment grade. So even if the company is a AA, AAA, really good company, if they are in a single B country, I can't invest. It's not a question of risk, I just can't, because the documents that govern my investment forbid me from doing this.
Right.
And so the question is, can we structure a way to get around the country ceiling? And so what you were describing is something that was very big in Brazil, it's been in other countries, and that was a way to bypass the credit quality of the country. So what do? So if I'm an exporter, and I'm exporting, let's say, textiles. Cambodia has a very big textile industry. So I'm exporting textiles to, let's say, Germany. It means I'm being paid by my German customers in euros, perhaps. The German customers hopefully are good quality customers. They're paying regularly. They're in Germany. Germany is a very high credit rated country. When I get this euro in Cambodia, I have to worry, even though it's the same euro, I have to worry about the ability to borrow against it because of the country rating. So what you do is you set up an offshore vehicle. Typically, it's in a country that has a much higher credit ceiling, and that company receives all of the money, all of the euros from the German customer that before were coming into Cambodia. So you set up this company. Basically, you are selling the receivables, the invoices. You're selling them to this offshore company. This offshore company raises debt. It issues bonds or it borrows money. The credit of this offshore entity is no longer in Cambodia. It's outside of Cambodia, and the assets are all German assets. And so now the credit quality of this entity is a German credit quality, even though the underlying receivables and the textiles are coming from Cambodia.
The ultimate beneficiary are here.
Right, and so you issue the bonds in outside of Cambodia against the receivables, and you do it because the credit quality is now a German quality. You do it at a much lower cost of financing than if you were to try to do this from Cambodia. And so it's a way, in a very odd way, you are getting around the country limit. But what you're really doing is reflecting the true credit quality of the Cambodian company. Right? They, putting aside this country rating, they were receiving money from these German customers anyways. The quality of the textiles were quite strong. This is why the German customers were buying it. What you're doing is just simply avoiding this country cap by moving the receivables or keeping the receivables outside of the country.
Right, but that SPV, the special purpose vehicle company, offshore company that you are mentioning, that company would have to comply with a lot of regulations from Germany itself, right? Actually,
so no. Well, yes and no. They would have to comply with the securities laws because they'd be issuing, it would depend on where their investors are. If the investors are in Germany or America or whatever, they have to comply with the securities laws of the country in which the investors are located. But the entity itself, it's just receiving money from on invoices. Right? I sold you textiles. So before, the Cambodian company said, okay, I'm selling you sweaters, and now you're giving me money for those sweaters. Now I'm saying, don't give it to me, give it to that entity. And that entity will use the money from the receivables to pay the investors. The money that we got from the investors, that will all come to me in Cambodia at a much lower cost of funding.
I'm sure depends on who we ask, right? Because tax regulators, the tax people would always take a closer look at what you're doing.
Of course. Oh, no. I mean, there's no question that similar types of structures in certain countries, like Switzerland, like Cyprus, are used as a way to avoid tax. But that's because they are not transparent. When Brazil and Mexico and other countries have done this, they are quite transparent. No one is hiding this. The tax people know what's happening. So the purpose is not to minimize tax, it's to lower the cost of raising money. So if the Cambodian company were to issue bonds, to raise money, it would cost what, 10, 12%, 15%, I don't know, but it would be quite expensive to borrow in Cambodia. If that same company was in Germany and wished to raise money, it would be what, 2 or 3%. Well, what are we doing? We are permitting the Cambodian company, based on the German receivables, to borrow money at 3%. That's all we're doing.
Okay. Now, you also mentioned about the need for tough regulation, even at the start, right? Because if everyone is informed, if we have a perfectly informed consumer, then in the end, that should help the wholesale. But when you have tough regulation, doesn't that lead to less space for innovation? Because people always complain about, why you try to regulate me too much that I just can't move. So what's your take on it?
Sure.
Regulation and innovation.
Remember, so it's tough regulation that is smart about the market, right? It's not just regulation that's tough, it has to be smart about the market. And so what that means is you need a regulator that is constantly learning about developments. Now, the fact is, regulation by its nature is conservative, right? I will regulate based on the market today. It's the point you made. I can't regulate based upon a crisis 3 years from now. I have no idea what that crisis is. So I will regulate based on the market today, and that market will change. And the regulator has to be sufficiently knowledgeable about the market to be able to adjust. Now, my understanding is that in Cambodia, the regulators have adopted a sandbox approach to new innovation. It's a very smart way of doing this. And so you have new companies with new products. They come in and work with the regulator. The regulator understands the products better. They're able to address regulatory issues and, as necessary, maybe even adjust regulation so that when the product hits the market, everybody is knowledgeable about what's happening. So tough regulation is fine if it is sensitive to the demands of the market. Now, there are some things that, you know, as a regulator, you're going to be more nervous about. And so in that respect, you might be more conservative than what an individual in the market wants, but that's fine. That's what a regulator does. They are looking at the entirety of the system. They're looking not just at this product or that company, they're looking at the totality of the market.
Right.
And so they may very well be more conservative, but that doesn't mean that innovation is necessarily stopped. It may mean that innovation has to adjust to reflect this broader concern that the regulator has.
Now, on that particular point, innovation, right? Everybody talked about blockchain, and all of that comes with NFT. We talked about it.
Yep.
So, can you spell out in a very short manner that how is the market on NFT doing in the States, for example?
So, NFTs, non-fungible tokens, they are a subset of sort of crypto assets.
Sure.
And so you have, you know, Bitcoin in there, and Ether, and, you know, hundreds of other blockchain-based tokens and crypto assets. And they all have different features. Some of them are intended for investment, in which case they begin to look like a security. Some of them are simply reflective of the ability to use the internet to collect funds for not investment necessarily, but to collectively go out and, I think we've talked about like buying a painting or something.
Yep.
And so it depends upon the nature of the asset. What you see in the United States is a big push by this industry to become less regulated. And they argue that the regulation is too ambiguous for them to be able to operate. They don't know where the line is. Now, as a law professor and a lawyer, I would say ambiguous is actually good. It's okay to be ambiguous. Why? Well, I don't want to say here's the line, because if I do this, you know, they're going to do everything they can to go right up to the line. And they will adjust the products to, in substance, be the same thing as a security, but not be a security because it gets around whatever this line is. So ambiguity in some respects is good. It forces people who are doing new products to be a little bit farther back from the line. And that's an okay thing. You don't necessarily have to push it all the way up to the line. The ambiguity is also not nearly as ambiguous as the crypto industry says it is. If you are experienced in this area, you have a pretty good idea of what is or isn't subject to securities regulation. But nonetheless, this is a big concern. And because the crypto industry is so big, they've raised billions of dollars, they have huge lobbying power in Congress. There is actually, this week, there were a whole series of hearings that are talking about creating new legislation for crypto assets. Take it away from the SEC. And the argument is that things like blockchain, things like Bitcoin, in fact, aren't really securities. You should think of it more like a commodity.
Right.
Commodities are different than securities, at least in the United States, because commodities are driven more by general market sentiment. Gold goes up and down, currencies go up and down, rather than individual investment opportunities, like buying stock in a company. And so we regulate it differently. It is less restrictive regulation. And so as a result, the crypto industry is lobbying heavily to have new legislation that takes this out of the SEC and maybe gives it to the commodities regulator.
Right, but how big is that chance of having this specific legislation passed?
You know, I'm always reluctant to bet on Congress. There's a lot of money pushing for this, and there are a lot of people in Congress who are up for re-election who need crypto money as part of their campaign for re-election. So if you had asked me 6 months ago, I would say 30% chance of success, but likely not successful. Today, it's closer to 50-50.
Wow.
And that's because there are so many people in Congress who are coming up for re-election who are looking for crypto support and you know, are quite deliberately appealing to the crypto industry to get support as a way to help finance their election or re-election. So it's becoming increasingly likely. Now, I will say, this idea of new legislation has been around for a few years. So it's not like this will happen necessarily right away, but the push is there. On the other hand, there are a number of senators, congresspeople, who are very focused on consumer protection, who want to keep this with the SEC.
Sure.
So there's a tension here. But the lobbying efforts, tough. You know, as you know, we had a huge scandal globally, and we continue to see this with companies like FTX that were you know, trading crypto assets, and it turned out to be just a lot of problems.
Sure.
At the time, the view was, no way will there be new legislation. But what, a year and a half later, again, it's coming up.
Sure. Okay, thank you very much. I think we have covered enough ground. Now, really, one last question to you. What's your, let's say, one advice each? One advice to our regulator here in Cambodia, and also one advice to our potential investors in Cambodia when it comes to securities.
So, again, I think the regulator is from everything I've heard and seen, they are approaching this in the right way. Education is key. And it doesn't start simply at adults. You know, it should be in high school, it should be in middle school, it should be in university, but there should be an ongoing effort to educate. And that's because the more education, the more trust, hopefully you develop collective investment vehicles that can inspire that trust. And so from a regulatory perspective, I know they're focused on education. I think that's a smart thing to do.
Good.
Anything that can enhance trust is a smart thing to do. You know, we do have industry-based sort of self-insurance in the broker-dealer industry in the United States. So if a broker goes down, the other brokers basically have self-insured. Why are we doing this? Again, trust. And so anything that the regulator can do to support trust, and that might mean tough regulation as well, openly tough regulation, this is a good thing. It's important, particularly for a new market where there's been a history of some abuse, to continue to grow. For investors, study, diversify, recognize that there is real risk here. And one of the ways in which to manage that risk is to not put all your money into a single stock, to look at multiple different opportunities, but at the same time, you know, study what's happening. Walk in with your eyes open, recognizing that you may lose a chunk of money. What it means is, if you're a younger investor, you're probably more aggressive. That's okay. If you're an older investor like me, you're probably more conservative. And that's okay as well. But you want to understand the type of risk you're prepared to take, given your entire situation, and manage your investments based upon that understanding of the risk.
Well, Professor Charles Whitehead, I always love talking to you. I wish I had all the time in the world to talk to you forever, but that can't do. So therefore, again, we and everyone here at CamEd Business School, we owe you gratitude and thank you very much for this wonderful chit-chat or more in-depth conversation on securities law. So we learned a lot from you, and I hope and I know that I will continue to learn from you.
Thank you very much.
Now and in the future. And hopefully we will come back and do this interview again, right? So until then, thank you very much,
Great.
Charles. It's
Thank
been
you.
a great pleasure.
Thank you very much.